there, this is Tantian. Today, we're talking about an oil producer company that is trying to change its business model through this pandemic. Unlike most oil producing companies, we are currently believing that the demand for oil will return eventually. This company decided to change part of its business to adjust to the future business environment. The company that I'm talking about is Exxon Mobil. So in today's video, we'll be talking about how Exxon Mobil is trying to innovate itself and will investors catch up to this trend. Before we continue, please smash the like button. And if you want to see more such videos, please subscribe to this channel. Firstly, we'll be talking about the business model of Exxon Mobil, one of the world's largest company by revenue. Exxon Mobil from 1996 to 2017 varied from the first to sixth largest publicly traded company by market capitalization. The company was ranked third globally in the Forbes Global 2000 list in 2016. Exxon Mobil was the 10th most profitable company in the Fortune 500 in 2017. As of 2018, the company ranked second in the Fortune 500 rankings of the largest US corporates by total revenue. Approximately 55.56% of the company's shares are held by institutions. As of March 2019, Exxon Mobil's largest shareholders includes the Vanguard Group, BlackRock, and State Street Corporation. Exxon Mobil is one of the largest of the world's big oil companies. As of 2007, it has daily production of 3.921 million barrels of oil, but significantly smaller than a number of national companies. In 2008, this was approximately 3% of world production, which is less than half of the largest state-owned petroleum companies. When ranked by oil and gas reserve, it is the 14th in the world, with less than 1%. Exxon Mobil reserves were 20 billion barrels of oil at the end of 2016, and the 2007 rates of production was expected to last more than 14 years. With 37 oil refineries in 21 countries, constituting a combined daily refining capacity of 6.3 million barrels, Exxon Mobil is the 7th largest refinery in the world, a title that was also associated with Standard Oil since incorporation in 1870. Secondly, we will be talking about the recent quarterly report from Exxon Mobil. Exxon Mobil said on last Tuesday it lost $20.1 billion during the recent quarter, its fourth straight quarter of loss as the energy giant grapples with the pandemic's impact on the industry. The company said that it earned 3 cents per share excluding items during the fourth quarter, which was ahead of 1 cent profit analyzed survey by Refinitiv expects. Revenue, however, came up short of expectation at $46.54 billion. The street consensus was for $48.76 billion. In the same period of a year earlier, the company earns 41 cents per share on an adjusted basis on $67.17 billion in revenue. During the third quarter of 2020, Exxon lost 18 cents per share on an adjusted basis while generating $46.2 billion in revenue. On last Monday, Exxon announced plans to invest $3 billion in carbon capture and other emission cutting technology. The move is too little too late for fighting climate change, according to some who say Exxon should have prioritized investing for the future. Peers include BP have also set new zero targets. Finally, we will be looking at how the company plans to adjust to a new climate change threat. Firstly, we'll be looking at a threat made by an activist hedge fund manager. Exxon Mobil is poised for a new role in a changing world it doesn't want. Target and test care for a new form of combined attack from activist hedge funds and long-term impact investors focused on sustainability and climate change. A newly formed activist investor group, Engine No. 1, announced plans on Monday to seek 4 board seats at the oil and gas giant, and underlying the efforts are both short-term and long-term goals to change the way Exxon approached the energy business at a time of rapid transition forced by fears about climate emission. Activists see opportunity in short-term value creation for a company that has been depressed by factors including poor capital spending, decisions during a cyclical downturn. Institutional investors, include pension funds, also see an opportunity to get an oil company that has ignored climate change engagement efforts to finally pay attention. And the three big index fund companies, BlackRock, Vanguard, and State Street Global Advisors, represents many individual investors who are increasingly worried about what may be a threatened Exxon Mobil dividend. Engine number 1 already received the backing of California pension giant Costa, which invests on behalf of the state teachers. Costa's chief investment officer, Chris Almond, told CNBC on Monday that the pension fund is becoming more of an active shareholder after previous work his pension fund has done with the Climate Action 100 Plus coalition to engage with Exxon has not worked. Secondly, we'll be talking about how Exxon Mobil plans to tackle this climate crisis. A week after multiple activist investor groups target Exxon Mobil for recent financial underperformance as well as climate change concerns, the oil giant has received a new 5-year plan to reduce greenhouse gas emissions. The company stressed that the plan has been in the works for months. Its previous 5-year plan through 2020 is drawing to a close, but it also noted in outlining new carbon goals that the plan includes inputs from shareholders. Investors willing to bet that there's a decade-long roadmap for big oil without a fundamental rethinking of the business model will view the next steps, which are new, as the incremental change needed to move in a future in which oil and gas remain relevant. And they are likely to remain the most concerned about ExxonMobil's ability to keep funding its dividend during a difficult financial stretch. Shareholders who think that the energy transition is going to occur more quickly and fossil fuel demands remains on downward trajectory are likely to view the plan as more of the same and not nearly enough. Finally, we'll be talking about the current shakeup in the board of directors in the company. Exxon Mobil announced 2 board seat changes, including activist investor and ESG proponent Jeff Ubben, and a sign that the company is confronting its uncertain future as the world moves towards cleaner energy and as investors shy away from oil stocks. The move comes as Exxon has faced pressures from shareholders to reshuffle its boards amidst the company's sluggish stock price. Ubben found Inclusive Capital Partners in 2020 after stepping away from Value Add, the firm he founded in 2000. In the last few years at the firm, he oversaw Value Add Spring Fund, which was focused on sustainable investing. Ubben is expected to become a significant Exxon shareholder over time, according to the source. Ubben is no stranger to investing in oil and gas companies. While at Value Add, he took a stake in BP, saying traditional energy companies can belong in ESG portfolio. Given that this change is being demanded by the new investors are hoping that ExxonMobil could shift part of its business away from crude oil. In conclusion, I strongly feel that ExxonMobil is a story-driven company. So if you believe that ExxonMobil will recover from this crisis, then you can purchase shares in the stock market in this stock. This is my personal opinion. With that, thank you, have a nice day. Goodbye.